Hello and welcome to a weekly musing. So this is a shout out to Ethan for suggesting this topic. This is a deeper dive into how the stock market works. So we're going to start with what is a black box model, and then that's going to lead us into some other things. So a black box model is any device, system, or object which produces information without revealing information about its internal workings. So the explanation for the conclusion is opaque or not see-through or black. So financial analysts, hedge fund managers, and investors can use software based on a black box model to transform a variety of data into useful investment strategies. So this can also be called quant investing. So basically, it is algorithms that that are created by someone somewhere that you're using, and they're going to take in a bunch of different information. If you take statistics, and if you've ever done a statistical model, then you know that there's a bunch of different things that you can take into account to see, does this affect the outcome? Does this affect the outcome? And if so, to what level? So all of that put together is an algorithm that is created to help people decide what investments they should proceed with or stay away from. So that is a black box model. And we're going to be talking about retail investors. What are retail investors? Well, that's you and me. So retail investors are individual investors, market participants from non-professional background who invest. And this is, like you're going, what is a DMOT? Basically, it's people like you and me that buy mutual funds or ETFs. An ETF is an exchange traded fund. So an ETF is like a mutual fund, but an ETF trades like a stock. So what do I mean by that? If you buy or sell, if you buy or sell a mutual fund, then you have to wait for the end of the day for that trade to happen. So if you look at whatever QQQ mutual fund and you say, okay, wow, the price is great, I want to sell it right this second, you cannot do that. You must wait until close of business that day, and that's the price you get. With an ETF also holds a basket of different stocks and bonds, but you buy and sell that just like you buy and sell stock, which means it's immediate. And when I say immediate, I mean seconds, less than a second. If I were to go online right now and say I want to buy or sell this stock, and as soon as I say make the trade, I immediately can go to status and the trade will have already happened. So with an ETF or with a stock or anything like that, the trade can happen immediately. With a mutual fund, it does not happen until the close of the day. So a lot of times people prefer ETFs, but mutual funds are also awesome because it's a way to diversify. So we've already explained what is a black box. It's an algorithm. It's a quant. What is a retail investor? That's you and me, as opposed to someone like Charles Schwab or one of the big banks that they're making trades on behalf of commercial customers. So now we're going to go in and we're going to say, how does a trade happen? Well, it's something called a market maker. One of the biggest is Citadel. So what is a market maker? A market maker participates in the market at all times. They are the unseen middleman. So they basically provide liquidity in that fraction of a second between a buy and a sell. If you are buying or selling something that will take longer than a fraction of a second, like a mutual fund or like an option, then they will provide liquidity for a longer period of time. However, the longer the period of time and the bigger the spread, and the spread is the difference between the ask and the sell. Like if I want to buy an option, just for example, for wheat in a month, and I want to buy it for $10 a ton, but it's the market trading price is 12, that's a $2 spread. The bigger the spread, the longer the time, the more they're going to charge me to make that trade. However, I don't know who they are. I don't know if Citadel or someone else is handling my trade. So that's a market maker. Citadel's the biggest one. They make billions of dollars through writing these black box quants. All right. So they provide liquidity and generates confidence in the market. So that's what they are. That's what they do. It's a very important thing because it is efficient capital allocation. So it ensures orderly trading of publicly listed securities, and you have dependability. You know your trade's going to go through, and it provides liquidity and depth. So this is a lot. I do know that. But if you look under what we do, you'll see that they do these equities, options, fixed income, what is a market maker, and then corporate solutions. If you would be interested in working for them, then you have to have a huge background in quantitative statistics or engineering. So you can make a lot of money, but the hours are really, really long. So that is an overview. If you have more questions about this, it's very, very interesting. Then let me know. If you have questions about something else that you would like for me to review, let me know that as well. And I'm happy to do research. It's a win-win. I learned something and you learned something. So have a great day and let me know what you'd like to hear from next.